In this section, we're going to talk about subordinated debt, but I first want to review the capital stack. We have senior debt at the top, subordinated debt in the middle, and equity below that. This is ranking in terms of priority from top to bottom, and the return profile is the inverse, with equity having the highest return profile and senior debt the lowest. So let's take a closer look at the senior debt section of the capital stack. There are a few main components of senior debt. Typically, companies have a revolving line of credit facility, and then they may have various tranches of term loans, A, B, and C in this example. This whole section makes up senior debt. Typically, this could represent up to 50% of the funding of an acquisition, and that equates to somewhere in the order of 2 to 3 times debt to EBITDA. So if you know a company's EBITDA, and it's a stable, fairly bankable business, you could assume that perhaps banks would lend 2 to 3 times its EBITDA for their senior debt. Or another way to look at it is 2 times interest coverage. So whatever the interest expense of this debt would be, the company has to generate sufficient cash flow to cover that 2 times over. The typical providers of senior debt include the commercial banks, credit companies, and insurance companies. Now let's take a look at how senior debt can enhance equity returns. So here's an example of a capital stack: senior debt, sub-debt in the middle, and equity at the bottom. Over time, over 3 to 5 years, as this business grows, what's going to happen is you're going to see that the equity piece has expanded significantly. The subordinated debt piece is exactly the same, and the senior debt piece is slightly smaller, as it's been repaid over its amortization period. So the value of the business has grown, but the majority of that benefit has gone to equity because senior debt's been paid down and subordinated debt has remained the same. So this is how private equity firms achieve their internal rates of return, and they may be targeting anywhere from 20 to 30% returns. So it's important to ensure that the amount of equity invested up front delivers that adequate internal rate of return, at least for a financial sponsor. And if there is a funding gap to fill, it's often filled with subordinated debt. Senior debt is maxed out, the equity component that's required is put in place, and hopefully subordinated debt fills that gap. Now let's move down the capital stack into subordinated debt. As you'll see on this slide, there are several types of subordinated debt. And at the top of the stack, we've got the highest security, and working our way down to the lowest security. But another way of expressing that is with this idea of increasing subordination. So as you move down from high yield bonds to vendor notes, you're becoming increasingly subordinated. But in exchange for that, you're also increasing the expected return. And finally, as you come into some of the lower parts of subordinated debt, like mezzanine debt with warrants, or payment in kind notes or vendor notes, you start to increase the dilution to the equity holders. So generally speaking, investors want to have as much of the top of the capital stack as possible, as the lower part of the stack starts to increase dilution and eat in at the equity returns. So let's take a closer look at some of these types of subordinated debt. And first, let's also look at how much subordinated debt a company can handle. So a business can only handle so much debt. And typically, the total debt to EBITDA could be up to 5 to 6 times. And if you recall from our senior debt presentation, if senior debt is 2 to 3 times, you sort of get a sense of how much sub-debt can be added onto that. We also look at EBITDA to cash interest of about 2 times. And finally, the equity funding piece could be as low as 30 to 35%. Of course, it could be 100%, but at the low end, probably 30% is a safe amount. And the appropriate capital structure has to be constructed with all of these pieces in mind: debt to EBITDA, cash interest coverage, and a minimum amount of equity funding. Now let's take a closer look at high yield bonds at the top of the subordinated capital stack. It's important to point out that high-yield bonds are publicly traded securities. That means they can be traded between investors, whereas mezzanine finance is not tradable. So let's take a look here at high-yield bond credit ratings. As you'll see across the top, there are 4 main rating agencies. The rating agencies provide these credit scores, ranking at the top from the most secure, at the bottom to the least. And it's very important here to draw this line in the middle. This line here is the difference between, on the top half, investment grade, and on the bottom half, non-investment grade, or high yield, or also called junk bonds sometimes. So at the top, these investment grade are lower risk and therefore lower returns and lower fees, a much larger and more liquid market. And then on the non-investment grade or high yield or junk bond, you have these higher risk and yet higher return and also higher fee types of bonds. So this is where high yield debt comes in on the bottom half of this table. Mezzanine debt, however, is non-traded and is also subordinated to the senior debt, like high yield debt. It often has a bullet repayment, and cash can be accrued, and there may also be equity warrants attached as well. The equity warrants give the investors exposure to equity upside. It's almost a sweetener on top of the return that they're expected to get on the actual interest payments. So there's debt with warrants, or convertible loans that entirely convert into equity, or convertible preferred shares. All of these 3 examples have equity exposure built into the debt security. Now let's take a closer look at the breakdown of mezzanine debt returns. So mezzanine lenders are typically targeting an internal rate of return of 14 to 20%. It consists of a few different components. The first is the cash interest that's paid by the company to the investor. And the second piece is the accrued interest. So part of the interest is paid in cash, part of it is accrued and ultimately repaid in principal. That comprises the contractual return that the company owes to the debt investor. But on top of that, they get their sweetener and their upside from the equity exposure. So this could typically include warrants that are 3 to 10% of the exit value of the business. These significantly enhance the internal rate of return of the debt investor. This has been a very high-level overview of several concepts that are very important in corporate finance. I would suggest that for more detail, you could look at taking our fixed income fundamentals course, which will walk you through bond pricing, yield to maturity calculations, etc. You could also look at our valuation course that covers various valuation techniques and looks at the use of leverage in enhancing returns. And then finally, all of our financial modeling courses will include debt modeling, and we'll look at the use of leverage in calculating internal rates of return and see how this actually plays out by modeling out in Excel.